Hi everyone, Nick here. Welcome back to my channel. Understanding your personal risk tolerance is critical to avoiding failure and being a successful investor. In this video, I'm going to share a story of an investor that will help illustrate the importance of understanding your risk tolerance. Then we'll discuss the types of risk and how these relate to your portfolio. Finally, we're going to look at the data and the impact of risk in some sample portfolios. In 1998, Kevin read an article in a magazine about a new ETF, QQQ, that diversifies your investment across 100 innovative companies in the NASDAQ 100. This sparked Kevin's interest, and he started to do more research. He was certain the internet and innovation would change the economy forever. He started investing every penny he could, which was about $5,000 per month. There was a lot of fear, uncertainty, and doubt about Y2K, but it passed and nothing happened. By January 2000, Kevin had invested about $100,000, and his portfolio was worth $250,000. He was making more money from his investments than his job. Kevin's conviction was so strong, he decided to take on a mortgage of $100,000 on his house. He used this money to invest in QQQ. By March, Kevin was feeling amazing. His portfolio had rocketed to $435,000. This was about a 20% return in just 3 months. At this rate, he'd soon be able to quit his job. And this is where Kevin's luck started to change. The financial results of many companies were below expectations, and the market started dropping. By January 2001, Kevin's portfolio was $265,000. In just 9 months, he went from being up $220,000 to being down. Many internet companies had gone bankrupt. Some fraud was discovered in sales forecasts, and people were talking about a dot-com bubble. However, Kevin was certain the NASDAQ companies would continue to innovate and change the economy. He kept investing. In September 2001, Kevin turned on the TV and saw planes flying into the World Trade Center. By the end of the month, Kevin's portfolio plummeted to $165,000. He was down over $150,000. At this point, all of Kevin's friends and family were telling him to cut his losses. He could pay off his mortgage, still be left with about $75,000. Kevin was still convinced that the NASDAQ companies would change the world. A year later, in October 2002, Kevin's portfolio had dropped from $165,000 the year before to $161,000, even though he had invested an additional $60,000. The NASDAQ just wasn't recovering. Kevin was now down $225,000. He was struggling to sleep and wasn't performing well at his job. It was taking a toll on his relationship with his wife. His friends and family kept urging him to reconsider. Kevin's conviction had started to fade, and he was questioning himself. The toll it was taking on his life was too great. He decided to cut his losses. He paid off his mortgage and invested the rest in a 5% CD at the local bank. This is a terrible story. Companies like Google, Microsoft, and Amazon have completely changed the world. However, Kevin got caught in the exuberance of an extremely optimistic expectations, followed by a crash and extreme pessimism. The story could have been worse had Kevin used margin instead of a mortgage. He would have likely lost all of his investment. While this is a fictional story, it helps us better understand risk tolerance. There are a couple broad types of risk. The first is idiosyncratic risk. This is an isolated risk, like the risk of investing in a single company, a single country, or a single sector like the tech sector. These risks are simple to mitigate with diversification. The second type of risk is systematic risk. This cannot be diversified. It's basically market risk. For example, in 2008, nearly every asset class dropped in price. It didn't matter if it was US stocks, international stocks, commodities, real estate. Bonds did pretty well, but not much else. This was an example of systematic risk. There are many specific types of risk that roll into these broad categories, but I'm not going to detail those in this video. Let me know in the comments below if you want me to make a video about the more detailed types of risk. In this story, Kevin got caught by both of these types of risk. While he invested in an ETF that diversified him from the risk of a single company, he chose an ETF for a specific sector. This was an idiosyncratic risk. He also suffered from the systematic market risk following the terrorist attacks on September 11th. In the end, Kevin made a mistake many investors make. He overestimated his risk tolerance. While Kevin had a very strong conviction, he wasn't able to maintain that conviction for the 5 years it would have taken for him to just break even on his NASDAQ investment. Had he been able to do that and stick with it, he would have then been challenged again when his overall portfolio went negative in 2008. It would have taken until about 2011 until Kevin would have broken even with inflation. 12 years of investing $5,000 per month just to break even. He would have then since done very well, but he would have had to maintain his conviction throughout that entire time frame. One reason many investors make such a mistake is loss aversion. Research shows that most people experience more pain from losing $100 than they do pleasure from gaining $100. This leads to many people making the mistake of cutting their losses in market downturns. They shift from more risky investments to less risky investments at just the wrong time. I think loss aversion actually goes both ways. People see their friends making money from things like Bitcoin or AMC, and they fear losing the opportunity. This leads to people buying investments after they've already gone up a lot, also at the wrong time. When it comes to risk tolerance, you need to consider two main things. First is your ability to take risk. If you're retiring in a couple years or saving for a down payment on a home, you probably shouldn't be taking margin loans and putting all your money into stocks. If you have a job that is more seasonal or unpredictable, you probably want to take a little less risk to make sure you have cash if you go months without work. Most market downturns have recovered over 5 to 10 years, but you need to be able to wait it out. If you need money to pay your bills or make a margin call, you cannot wait and may be forced to sell. This brings us to the next thing you need to consider, which is your willingness to take risk. Even if you have the time to wait it out, you may not want to or be capable of it. Many retirees have low-risk portfolios because they don't want to watch decades of hard work and savings lost in a 50% market crash. They will be happy and live well with the lower returns of a conservative portfolio. They won the game, and they don't need to keep playing. Some people are just more risk-averse by nature. If your investment portfolio is causing arguments with your spouse, difficulty sleeping, or decreasing the quality of your life in other ways, you probably have too much risk. In the end, this is what got Kevin. The emotional toll it took on him led to selling at nearly the bottom of the market. He bought high and sold low. This can really ruin your returns. As an investor, you need to carefully consider your ability and willingness to take risk. I want to show you 3 portfolios to illustrate how you can adjust the risk in your portfolio and how they have performed historically. Before we do that, I just want to say thanks for watching and supporting my channel. I do my best to deliver high quality, dense content that is packed with value. All I ask from you is to smash the like button and subscribe to support this free financial education. If you know anyone that would benefit from this content, please share it with them. The portfolios we will look at are all 3 fund portfolios, which I believe is the best portfolio for most investors. I made a video detailing why this simple portfolio is extremely efficient, well diversified, and elegant. I'll put a link up here and below. One of the principles of this portfolio relates to using a single bond index fund to adjust the risk. I made a video on bond fund strategy detailing why using a single high-quality bond fund is a very efficient way to reduce risk. I'll also link that up here and below. We'll use Portfolio Visualizer to compare some portfolios. The first portfolio will be a very conservative portfolio. It has 80% in bonds, 15% in US stocks, and 5% in international stocks. The second portfolio is a moderate portfolio with 40% in bonds, 40% in US stocks, and 20% in international stocks. The third is an aggressive portfolio with 60% in US stocks, 40% in international stocks, and nothing in bonds. All 3 of these portfolios remove idiosyncratic risk as they are globally diversified across all sectors. We will run these portfolios for the same time frame as Kevin's investments from 1999 through now. In this scenario, we will say you started with $10,000 and invested $1,000 each month. The MWRR column is the annual rate of return after adjusting for contributions. We can see the very conservative portfolio would have provided a 5.4% return over this time frame. The moderate portfolio with 40% bonds and 60% stocks returned 7.7%. The aggressive 100% stock portfolio returned 9.15% annually. The worst year shows that the worst year for the conservative portfolio would have been a 4% drop. The moderate portfolio had a 22% drop in 1 year, while the aggressive portfolio had a 40% drop. In this example, even after 13 years, in 2013, these portfolios were all roughly in the same spot. They have diverged much more recently, but even the moderate portfolio has provided a pretty good return. This is a good example of the risk-return trade-off. Taking more risk increased the returns, but also had more drastic short-term drops. If we were to split the difference in the moderate and aggressive portfolios, use 80% in stocks and 20% in bonds, it would have returned 8.7% yearly instead of 9.15% for the 100% stocks. It would not be that far off the 100% stock portfolio while reducing the maximum drop to 30% per year in 1 year from 40%. As an investor, you need to carefully consider your risk tolerance. Your willingness and ability to take risk should guide your decision. I think many new investors tend to overestimate their risk tolerance, especially right now in the middle of a 12-year bull market. Everyone thinks they're a hyper-aggressive investor with all stock portfolios, some even with some margin leverage. Yes, we had a crash last year that recovered in just 3 months. But can you hang on for a few grueling years where you're contributing month after month just to see your portfolio move backwards by the end of the year. I think it makes sense for newer investors to take less risk than they think they're capable of. After experiencing a real bear market, you'll be better able to judge your risk tolerance. It may be worth accepting some lower returns if you'll need the money soon, if it will keep your peace of mind, or if it prevents you from panic selling. Thanks for watching, everyone. I hope this video helps you think better about your personal risk tolerance. If you got value, make sure to smash the like button to support free financial education. Then subscribe so you don't miss future content. Later.